Welcome to today's review of the True Potential portfolios and financial markets. My name is Paul Durrans and I'm an investment analyst at True Potential, and I'm also delighted to be joined by our investment director, Chris Leyland, who manages the True Potential portfolios. So Chris, 1 month on from our last video, markets have certainly been difficult with heightened volatility in equity markets. Why have markets been so unsettling?
So as we move through the year, market conditions have varied, culminating in a volatile October. Many investors feel that the US potentially has become a little bit ahead of itself, with investors nervous around global growth should the Federal Reserve keep raising interest rates. This type of backdrop, it reminds us that multi-asset investment is beneficial, not just being restricted to one single asset category. When prices fall in one area, but actually not in another, it opens up opportunities for us to buy quality assets at lower prices. So agility brings rewards.
So what are the key risks right now?
Risks remain apparent, but actually there's nothing new. They've been on the horizon for some time now. Brexit instability, the potential for a US-China trade war, and nervousness around interest rate rises within the US. In fact, actually they've been around for virtually the whole of 2018, and this negative sentiment is now being absorbed into prices. If we look at what's happened in November so far, global stock markets have shown in general positive returns, bouncing back from October's volatility, with emerging markets and Asia showing clear leadership. Some of our managers have used this as a buying opportunity, accessing assets at, more favourable prices in order to target growth opportunities. What we're really seeing is investor styles are evolving, no longer being driven by price momentum, but the more traditional factors such as valuation.
Have the managers moved more defensively?
Well, our managers have been making underlying changes, so rotating to more defensive asset classes such as bonds and alternatives, but also actually sectorally making changes within their equity allocation. So for example, Close Brothers, they've been trimming some of their growthier US tech stock allocation, and that's after very, very strong Q3 earnings. And they've been buying more value, quality orientated stocks, so sectors such as utilities.
So what changes have you made within the portfolios?
I guess in terms of portfolio positioning, we've been making quite small tweaks to the manager allocation, and always the emphasis is on manager style, so investment style. We've trimmed exposure to Allianz and Goldman Sachs. We've added to Close Brothers and also to the True Potential Growth Aligned fund range. We switched money towards Close Brothers, and that was based upon their strong stock picking skills, which have worked very, very well during the recent volatility, but also, their investment style of quality growth. It offers diversification, and it's expected to continue to contribute to the overall diversification of the portfolios. We added to the True Potential Growth Aligned fund range, and the funds perform very well, illustrating, a strong asset allocation, but also a strong fund selection process.
So tricky markets recently, but we've made a number of small portfolio changes to hopefully help the portfolios navigate through markets going forward. I suppose what everybody wants to know is what your expectations are for the next 3 to 6 months, and can investors expect positive returns?
Yes, positive returns can be had. You've got to think about equity markets. They've fallen, so asset prices are now lower. And I think when we speak to the fund managers that we work with, our fund manager partners, we're all still constructive on the overall outlook, citing generally accommodative monetary policy, robust economic data, attractive valuation levels, which we mentioned before, and strong company fundamentals. However, what you find is the positives can be masked at times by worries, and those worries push prices down. But however, that creates opportunities, and those opportunities to invest using positive cash flow, and that's something that we're benefiting from, unlike other investment managers right now. We must stress again, and I really do want to stress this, that for long-term investors, negative sentiment is of limited concern. It means potentially higher returns lie ahead, provided positive fundamentals remain intact. Thank you.
So to sum up, we still remain constructive on markets moving forward. Risks are clearly apparent, but it's important not to get bogged down with the negatives as you potentially lose out on the positives. The key is to stay invested, downplay media scare stories, and compound up on investment growth.